You're listening to QSBS Solved, where we share insights for founders and investors looking to maximize their business's growth, exit opportunities, and tax savings. Our team at QSBSrollover.com offers specialized services to help you benefit from owning qualified small business stock. Our podcast guests are leaders in their respective fields and work on every side of the startup journey to help founders and investors win. The ideas and opinions shared here are not investment, tax, or legal advice. Reach out and we'd be happy to connect you with a qualified advisor or tax counsel. For now, enjoy today's episode. Hey everyone, welcome back to another episode of QSBS Solved. I'm Brady. I'm here in studio with Mr. Mark Leeds of Pillsbury Law Firm in New York. Mark is an attorney, tax attorney, and is going to talk to us today about startups using tax incentives, especially startups using tax incentives to attract private capital. Mark, it's good to have you here in the studio.
Brady, it's a pleasure to be here. I'm really grateful for the opportunity to present to your audience. Just by a little bit by way of background, as you mentioned, I am a tax partner here in Pillsbury in the New York office. I do a substantial amount of work with both startups and family offices, strategies for obtaining capital for new businesses. And I hope to share some of those opportunities this afternoon. So I think, want to just get started?
Yeah, sure. I mean, when Mark and I first talked about coming on, we were kind of throwing around some ideas, and he said, well, I have this presentation that, I've been working on and have had in the past. And I was like, this is perfect for our audience because, we want this to be applicable broadly to startups, but also potentially other private capital raisers like venture funds. And, there's some overlap here, especially when we talk about QSBS. So excited to have you on, and let's jump right into it.
And well, I think probably the first topic that's worth talking about then is QSBS itself, what it is, how it works, and how entrepreneurs can use it as a means of attracting capital to their business. The qualified small business stock requirements are first that it must be issued by a domestic C corporation. Historically, that might have been somewhat of a challenge. And the reason why is because historically, corporate rates weren't as low as they are now. Currently, we've reached a really unusual place in tax history, and it looks like after the passage of the One Big Beautiful Bill Act that we're going to have the current rate regimen in place. And the current rate regimen does not impose any penalty whatsoever for using a C corporation. Most people get really sort of caught up in the idea of double tax. But double tax today is really a misnomer, and let me tell you why. The reason why it is because if you held a business directly in a partnership or other pass-through format, the ordinary earnings from that business would be taxed at a 37% rate. If you conduct the business instead through a C corporation, it's only taxed at a 21% rate. When you distributed the earnings of that business to yourself, the 79 cents on the dollar that remains after the corporate tax is taxed at a 20% rate. The effect of those two combined rates is a combined tax rate of 36.8%, so virtually indistinguishable from the 37% rate that applies to operating outside of C corporation format. So as a result, there really isn't a double tax imposed on C corporation earnings. In addition, because the corporate rate is only 21%, if you want to reinvest those earnings in your business, you're much better off in doing so through a C corporation. If you held the business directly, you'd owe tax at federal alone, you'd owe tax at a 37% rate, giving you only 63% that you could reinvest in the business. On the other hand, if you operate the business through a C corporation with a 21% corporate rate, you can invest 79 cents on the dollar after taxes in the business. So the C corporation format, it really isn't a disadvantage. And with respect to reinvested earnings, it's actually a real big advantage. If you're using a pass-through format, you'll never get the qualified small business stock advantage on entity value realizations or dispositions of the business. And if you do the same business through a C corporation, not only do you get the benefit of the rate advantage that we've been discussing but if you meet the requirements that we're going to go through, the qualified small business stock gain will be exempt from tax, or a lot of it will be exempt from tax. So while you sometimes hear when you start talking about qualified small business stock advantages, but I've got to pay double tax, that's really no longer a disadvantage of using the qualified small business format anymore. So, and arguably, it's a real advantage to be able to operate in the C corporation format to take advantage of the rate advantage that exists, especially with respect to reinvestment earnings.
How Mark, if I can jump in, how many maybe pass-throughs and S corp entities out there do you think really the structure is just sort of outdated for most businesses use case, even maybe family-owned legacy businesses? Is it advantageous for possibly a lot of these pass-throughs to convert now under this new regime?
I think it's certainly worth looking at, and in a lot of cases it is. One negative that existed prior to the passage of the current tax bill was people didn't believe that the low rates were going to be around for as long as that they have been. And so people who were in pass-through formats, whether in LLCs or other types of businesses, were really hesitant to move to the C corporation format because they felt as though that there was a real risk of bait and switch. And during the election campaign, there was talk on the Democratic side about increasing the corporate tax rate, which would have skewed these advantages back to a pass-through format. But now that we've gotten the passage of the OBBBA, or the HR1 as it's sometimes called, and I think that the Republicans have rebranded it as the Working Class Tax Cut Act, something along those lines, because the OBBBA got some bad press, and so they were trying to avoid that. But regardless, we are in a situation now in which it looks like that the current rate regimen is going to be in effect for a significant amount of time. It's permanent on the books. It goes without saying, I believe it's something along the lines, no man's life or property is secure when the legislature is in session. Always some degree of risk. But from where we sit now, it looks like the current rate structure is going to be permanent or semi-permanent, or things will move in tandem, which will leave you indifferent. So yes, I think that it does make a lot of sense for businesses that are in pass-through format to think about whether or not it makes sense to move to a C Corp format. Moving to a C Corp format, if you're in an S corporation, though, may be difficult if you're already in an S Corp format getting to QSBS. But if you're in a partnership format, the conversion should be treated as a contribution of property to the C corporation, which would enable you to take advantage of the QSBS benefits, which have become even more substantial under the new legislation. A third requirement over and above C corporation stock issued in exchange for money, property, or services is that the issuer must be engaged in an active business during substantially all of the stockholders' holding of the stock. So unless you're an IP leasing company, and even then, if it's self-developed IP as opposed to purchased IP, or trading stocks and securities, which may not make the most sense to conduct through a C corporation, that's going to be met in a vast majority of cases. When we're talking about entrepreneurs and forming new businesses, those businesses tend to meet the active trader business requirement. So while it's something you want to certainly keep your eye on, unlikely to be a significant impediment in getting to QSBS status for the stock that gets issued.
Where that does come up, at least in our side of the business, when we're talking about QSBS rollovers, is traditionally people have gotten to their head that they can take cash from the sale of one stock and roll it into a new corporation and just have that money sit there while their QSBS clock keeps ticking. But you actually have to do business in your rollover entity. And so that is a place actually where we've typically seen entities not hitting that active business during a rollover situation. And that used to be common practice. We're trying to make that obsolete.
Yes, when you're looking to do a monetization transaction and you're looking for a holding vehicle for the monetization to satisfy the QSBS requirement, what is the 10-year rule. We'll come to that in a second. That's been substantially lightened under the OBBBA. And so benefits are available much earlier in the process. So it may not be as much of a challenge beginning in 2026 as it has been today. The fourth requirement, which is sort of worth mentioning, Brady, is that currently gross assets cannot exceed $50 million and before the stock is issued or immediately afterward. That $50 million requirement is going up to $75 million beginning next year. So if you're in that sweet spot where your business is currently worth more than 50 but less than 75, you will be able to take advantage of the QSBS issuance rules beginning in 2026. There are rules to prevent gamesmanship on the QSBS issuance. And what they do is they prevent the company from having redeemed stock and then reissued stock. So there's anti-redemption rules. The issuer cannot have redeemed more than 5% of its stock during the 2-year period beginning 1 year before issuance. In other words, there's a window around the stock issuance that looks back a year and looks forward a year, sort of like the old Greek god Janus, right, who had two faces, one looking forward and one looking back, sort of the way to think about it. Some people get a little flummoxed by a 2-year period that begins 1 year earlier. But if you sort of think of the Greek god Janus looking both forward and back, it's that principle. And the issuer cannot have redeemed stock issued to the taxpayer who's getting the stock during a 4-year period, beginning 2 years back and then looking 2 years forward. So while you can't game the value of the company through stock redemptions, you also can't effectively take stock, which was non-QSB stock when issued, redeem it, and then reissue stock and treat it as QSBS during that 4-year window. Let's talk a little bit about the active business requirement now and what that means. The active business requirement requires that at least 80% of the assets of the business be used in the active business. You are permitted to have reasonably required working capital if it's less than 50% of assets. So during the startup phase of the business where you're not fully invested, you can still have QSBS, keep the clock ticking, not ruin the company for its QSBS status if the working capital is less than 50% of gross assets. As you put that money, in other words, not requiring that the money be put to work on day one in a way that would be either disadvantageous or expedient for the sake of tax. There's a recognition within the statute itself that you can ramp up, as it were. And in addition to the working capital relief, there are 3 other types of expenditures which will count toward active trader business. One is startup activities, which themselves are not considered trade or business activities, but startup activities will count toward the active business. Second is in-house research and development is absolutely fine and treated as active trader business. And thirdly, R&D expenses, payment for R&D to third parties will constitute active trader business use of assets, which is important. Certain businesses, it's also worth noting with respect to active businesses, certain businesses don't count. And you really need to be thoughtful around here. So I'm going to read off a list and then come back to how that list isn't really as onerous as it sounds. So what they're saying is that performance services in health, law, engineering, architecture, accounting, actuarial performances, performing arts, consulting, athletic, financial services, brokerages, or businesses in which the skill of a single employee is the principal asset don't count. Sounds like it's pretty limiting, right? But basically what they're saying here is that if you're a law firm or an accounting firm or an architecture firm or a firm where or a performer, those aren't the kind of businesses that QSBS is intended to reach. However, there's a lot of really interesting private rulings that have been issued over time that businesses that are adjacent to these, such as you can, like, for example, if you're a law firm and you form a service corporation off on the side that provides services to the law firm, such as file storage, facilities, and that type of thing, that will work. And certainly there's really good authority in the healthcare area regarding healthcare facilities that don't themselves constitute the performance of medical services that also count. So there's a lot of ways of slicing and dicing businesses to come up with portions of the business that will qualify to issue QSBS. In addition, 4 other sort of broad categories that are sort of suspect: banking, insurance, financing, leasing, and investment is sort of a category of itself. What they're saying there is that a brokerage is not eligible, or investment advisory is not eligible, which sort of makes sense given the way QSBS works. Farming, unfortunately, is not eligible. Mineral extraction, not eligible. Neither are hotels. In other words, if the business is just too service oriented, it's probably one way of thinking about it, as opposed to goods or ancillary services. So depending on where you are, these are definitely guardrails that you need to think about with respect to QSBS issuances. Some other pieces that need to be taken into account: real estate cannot exceed 10% of total assets. Recapitalizations of QSBS, if you recap your company and you had QSBS outstanding, the QSBS status will attach to the recapped shares. It's very, very helpful as you move forward and bring in outside money. So we spent a lot of time talking about what is QSBS. Now, why would you care, right? What are the benefits of having it? With respect to QSBS issued before 2026, which when we're doing this podcast is be this year, 100% of the gain is excluded up to the lesser of 10 million and 10 times the basis of all QSBS disposed of in that year. So you can exclude 100% of the gain, but it has to be, the stock has to be held for at least 10 years. The QSBS issued in 2026 and after, eligible gain is up to 15 million, and the timetable has been substantially reduced. QSBS held for 3 years, 50% of the gain is excluded. QSBS held for 4 years, 75% of the gain is excluded. And QSBS issued for at least 5 years, 100% of the gain is excluded. With these, for the QSBS issued in 2026, the rollover transactions that you have been so active in there's a lot less pressure because there's no longer just that single cliff. Now there are these tiers beginning at the 3rd year that allow you to exclude substantial amounts of the gain. So very, very helpful.
I wanted to clarify, Mark, that under the old rules, the 100% exclusion comes in at year 5.
Right. I'm sorry.
I misspoke and said 10. That's okay. So I wanted to clarify for everyone.
That shows you how old I am.
That's okay. The 100% exclusion, as Mark just said, didn't move, but we did get tiered exclusions that happen much sooner at years 3 and 4, which can certainly be advantageous for instance, founders maybe taking secondary earlier, possibly as part of a funding round. We see a lot of founders who maybe take secondary at while they're raising a Series A or B. and they're at 3 years. And in the past, they weren't getting a benefit. And even today, that founder isn't getting a benefit, but in 2028 or 9 forward, where we have instances where someone's stock has been issued after that July 5th date, that could very well be, a part of their QSBS story.
So there's real opportunity there, and the rules are only getting better next year. Apologize for the errant reference to the old holding period. Next topic we want to talk about is for folks outside of the QSBS regimen, which is referred to as qualified business income. It wasn't lost on Congress that the substantial benefits that they provided for people conducting businesses in C corporation formats. And they wanted to offer at least some degree of comparable benefits for people who conduct business in pass-through formats, whether it's an S corporation or partnership. These are limited to, I'm going to say, moderate income individuals. And the benefit allows you to claim a deduction for your qualified business income of 20% of your taxable income over net capital gains. You can, that 37% rate is reduced by a 20% deduction for qualified business income. Benefit, however, is limited to taxpayers with incomes of this year, because of inflation adjustments, of $197,300. If you're married, that jumps by 2, and it can be up to $394,600. For the entrepreneur who's in pass-through format, who's taking who's still building the business, and net income is moderate. The net income that he's receiving is moderate, and I don't mean to disparage people who make $309. That's a pretty significant amount of money, but it is limited. And again, just like with the QSBS active business requirement, it doesn't include certain specified trader businesses. So it's more for non-engineering, accounting, and law, like myself. And the benefit limit, interestingly and importantly, is determined at the shareholder or partner limit. So if the business is doing income in excess of that 197/394, if you're married, limit, you're only looking at the income that's allocable to you. So if you run in outside money to the business and they're taking up a big slug of your startup income and leaving you in that range underneath the 394 if you're married, the entire amount that you get is going to be eligible for that 20% deduction, even though the business itself might be generating significantly more than that. So it's another benefit for startup entrepreneurs that helps reduce the tax burden if you are in pass-through format. I'd like to move on now to a third benefit, which is really pretty phenomenal. And that is that what we refer to in the tax field as bonus depreciation. Bonus depreciation had gone away, but was reinvigorated and reenacted by the OBBBA. And what it is it gives you a 100% deduction for new property put into service. So if your business is otherwise relatively profitable, CapEx expenditures can be a way of substantially mitigating your tax expense here. So let's talk about it. And that is this is retroactive from where we sit today. Beginning after January 19th, 2025, eligible businesses can take 100% deduction for the cost of qualified property in the first year the asset is placed in service, eliminating the phase-down schedule that had been in effect under prior law. Qualified property includes most tangible personal property, including machinery, equipment, furniture, computers, computer software, and improvements to non-residential real estate, including qualified improvement property. The property must be acquired in an arm's length transaction after January 19th, 2025. Assets under buying binding contracts put in use after, pursuant to a binding contract before that date are not eligible, and includes both new and used assets. So if you're seeing a bargain out there, and maybe it's not something you need exactly today, but you anticipate needing in the near future, it might be worth swooping in and buying that asset as a way of mitigating your tax exposure. In other words, the amount that you pay for the asset is partially financed through the tax savings. So it really is a wonderful opportunity. The bonus depreciation had gotten some bad press, to be quite candid. And the bad press didn't relate to the deduction itself, related to the use of the deduction. A lot of that's probably not the right way of saying it, but a certain number of folks who had come in to instant wealth, either through IPOs or otherwise, had been purchasing airplanes on December 31st as a way of mitigating their tax, and so that had gotten some write-up, but that negative write-up shouldn't cause someone who otherwise is in entrepreneurial mode to run out and buy property as that might be eligible for the benefit because it really is just a great opportunity for mitigating tax exposure. Moving on then to the next form of deduction, which has been greatly enhanced by the new tax legislation, is the research and development expenses. Research and development had been, for a long period of time, had been immediately deductible. And then under the Tax Cut and Jobs Act, which was in effect before the new legislation, the amortization schedule for R&D had been extended to 5 years. And what the One Big Beautiful Bill Act did was it allows an immediate deduction for R&D expenses. So to the extent that your business is maybe just jumps to my mind on the internet, and you're doing a substantial amount of R&D in both determining who your user base is going to be and how your app is going to work, and all of those type of expenditures. Those expenditures are now immediately deductible. So to the extent that you have income or you don't have current income, it's generating a net operating loss, which is absolutely going to be fully utilizable on a go-forward basis. You create this wonderful deduction for the amounts that you expend to get your business up and running. And what was so interesting was that Congress and the president decided that this deduction was so important that they did their best to make it as retroactive as possible. So how could they do that? They did it not by allowing you to go back to prior years, but if you have unamortized expenses that were incurred in prior years, you can claim them as an immediate deduction beginning in 2025. So if you had research and development expenses that you had incurred in prior years that you were bleeding into over time, you can make an election to claim them as an immediate deduction in this year. And so it's a wonderful opportunity for mitigating your taxable income by essentially immediately deducting those prior years. So it's really, really a great opportunity, just like the bonus depreciation. And these are clearly tax benefits that are geared to the entrepreneur that will allow you to mitigate your tax liability for the cost of getting that business up and running.
Is there a cap that I missed? You state on the R&D side, what you just mentioned, of how much you can exclude?
No, they're not on the R&D.
Okay.
Deduction itself. Actually, we'll come now to the next limitation, which is the caps.
Okay.
So it actually doesn't serve as the cap on the deduction itself, but when you combine all of these benefits, you can literally turn income into current losses, right? Because what you're doing is you're taking expenses which unquestionably have future benefits, but for which the tax law is encouraging you to incur, that will wipe out current income, right? And so for outside of the C Corp format, where we have the individual incurring the deduction or the deductions passing through the S Corp and or passing through a pass-through structure or partnership, you're going to have active business losses, right? And what the tax code does is it creates a limit on the amount of active business losses that an individual can deduct in any single year. So if you're claiming a salary from the business or you otherwise have income, having these active business losses can be a great benefit, because not only do they don't ring fence themselves around the business, they create deductions that can be used against other income as well. And what the active business loss limitation does is it limits the amount that you can shelter from other sources. And what it does is that for 2025, the amount that can be deducted is $313,000 for single filers and $626,000 for joint filers. If you have active business losses in excess of that amount, those excess carry forward as a net operating loss. Interestingly, I think maybe probably the best way of saying it is due to a quirk in the tax code, the net operating loss is not subject to the same limitations that the current active business losses have been are. So if you have a net operating loss that exceeds those thresholds, it will be fully deductible in the succeeding year, even though it was limited in the year in which it was incurred. Congress is aware of this. There was some talk about changing it so that the carry forward would also be subject to the same limitations, but Congress, in its infinite wisdom, decided not to do that, so that the excess carries forward. And the way that the rule physically works is you aggregate all of your business losses, you subtract out all of your business income plus the threshold amount. This limitation applies after other tax rules, such as passive activity loss and at-risk limitation. Passive activity losses are unlikely to be a limitation for our entrepreneurs who are spending their time active in the business. The passive activity losses seek to limit the ability of people who purchase interests in active businesses as opposed to our entrepreneurs. The last topic that I'd like to discuss today are qualified opportunity funds. And quality opportunity funds are a way, I'm going to say it this way, is a way of raising money for your business. The way that the qualified opportunity fund rules work is they strongly encourage the entrepreneur to create a tiered partnership structure. That never was really clear to me, to be honest, to why the tiered structure was given so much more preference over the single tier structure, but it's a two-tier partnership structure. And at the top is a qualified opportunity fund. And what the qualified opportunity fund rules allow you to do is to raise money from investors who otherwise have capital gains, whether or not it's from crypto, whether or not it's from stock market. But it has to be a capital gain. And to the extent that our investors may have short-term capital gains, this is a real home run. I think probably the way it makes most sense to talk about these rules now is to talk about the rules that are going to become effective next year, because the rules were written originally as a snapshot. And what happened was Congress realized that thinking about them as a rolling benefit made a lot more sense. And so when the OBBBA was enacted, they went from that snapshot to this rolling format that I think makes most sense to talk about now. So really what we're talking about now is raising money in the second half, just the way the rules work, in the second half of 2026, that would be invested in a business in 2027. The one thing about the QOF rules or Qualified Opportunity Fund rules, sometimes you hear the accountants talked about them as QOFs, and there's a large number of acronyms that get thrown around just because of the way the statute is written, but that shouldn't deter people from trying to understand these rules because they are so beneficial and they have the opportunity to attract substantial amounts of capital. The one thing that's unusual about them, that's very special, is that they only apply to businesses which are operated out of designated tracts, census tracts that are chosen by the states and then approved by the IRS. We know what those are today for the old rules, and they'll be changing on a go-forward basis beginning in the second half of 2026. That'll tell us where they are in 2027. And there are going to be two sets of rules on a go-forward basis for 2027. Rural qualified opportunity zones and then the regular ones. The rural ones are going to get substantially more benefits, which actually makes a lot of sense. The way that the Trump administration has been moving with the tariffs has had a disproportionate impact on rural America. And so the qualified opportunity fund rules are one way of mitigating that negative impact by creating more incentives to build and undertake projects and businesses in rural America. And so what it does is that the way headline is the way that it works is that an investor who contributes an amount to a qualified opportunity fund that is equal to his or her capital gains incurred within 6 months of 180 days of the contribution to the QOF can avoid paying tax on those gains on what's going to be a rolling 5-year period. Let me explain a little bit what I mean by rolling 5-year period. That it doesn't really matter anymore or going forward, which is a big change from existing law as to when the contribution is made. If you have those gains within the 180-day period prior to the time of your contribution, you can, for 5 years, you'll be able to avoid paying tax on those gains if you roll an amount equal to the gains into the into the qualified opportunity fund. If the gain is, and then those gains themselves are going to be tax benefited. And we'll come back to that in a second. Furthermore, any gain that they recognize on your business, which is where the money is going, that is recognized after at least 10 years is tax exempt. So the benefits are essentially twofold. You get a substantial deferral and a possibility of some tax exemption on the gains that are rolled into the Qualified Opportunity Fund, and any gain on the disposition of the investment made into the Qualified Opportunity Fund is tax exempt if recognized after 10 years. Quite some.
Can the owner or I guess like the principal member of a business set up a vehicle like that and invest his own proceeds through the Qualified Opportunity Fund?
Absolutely.
Business, yeah.
So, Brady, like when you talk about doing QSBS rollovers, one opportunity, no pun really intended, is instead of doing a QSBS rollover, is that you roll over into a QOF, Qualified Opportunity Fund, and take advantage of the gain deferral rules there. And in order for the investment itself to be a good Qualified Opportunity Fund investment, what's referred to as a Qualified Opportunity Zone business, they're very liberal rules. Only 50% of the active gross income has to be derived in the Qualified Opportunity Zone itself. So up to 50% of the business can be conducted outside of the Qualified Opportunity Zone. A use of substantial portion of the intangible assets has to be used in the active business in the QOZ, and that's even less than 50%. There is a limitation of 5% on financial assets, but working capital is liberally construed here as well. And then there's what's pejoratively known, you can't do a sin business. And a sin business includes, I didn't list them out here, massage parlor, gambling, those type of businesses are not eligible. And so then tangible property has to be acquired by purchase from an unrelated party. And it can include land in the qualified opportunity zone, a building that is first used, a building that was previously used in a business, but if it's substantially improved, that'll qualify as a good. Equipment that was never previously used in a qualified opportunity zone, or equipment that was previously used in a qualified opportunity zone, but is being substantially improved. And so there's real opportunity here with respect to the type of gain that can be invested, because if you earned the gain through a partnership, you have an election to use either the date that the gain was recognized or the last day of the taxable year in which the gain was recognized. So it creates a very substantial period of time to make this decision as to whether or not you're going to make the investment.
It can be a good way to use capital gains from maybe the sale of real estate to reinvest into a business, because oftentimes I think folks who own real estate as assets think about their benefits when they have a gain as rolling that into more real estate, but this provides them an opportunity to maybe fund their own business or another business through a capital gain. Yeah.
Great. Yeah. Startup cap.
That's right. Yeah. Correct. Yeah.
So those are the topics that we wanted to talk about. Just in summation, we spent some time talking about qualified small business stock, which I know is near and dear to Brady's heart. After we spoke about that, we talked about some opportunities for people in pass-through formats, qualified business income, bonus depreciation, which would apply both to C corporations and to pass-through businesses, R&D expenses, which likewise would apply both to corporate businesses and just to be clear, bonus depreciation and R&D expenses can be claimed by a corporation that's issued QSBS. So there's no reason why these benefits couldn't be married to each other.
Yeah, when we talk about someone trying to attract outside capital to their business, it's very clear to me that QSBS and QOFs are something you can put on the front of your marketing docs. In other words, but knowing that you have, for instance, a principal of a business who has advisors and they themselves are privy to and paying attention to things like QBI, bonus depreciation, working that into part of your story when you're raising capital can give investors, a lot of confidence that you're paying attention to the efficiency of the capital that's going into the business. Correct?
Could not agree more. That is
so. What would you say if you could give us maybe like two thoughts off the top of your head of how thinking about entrepreneurs, startup founders can do a better job of communicating these benefits to actually attract new capital that they weren't going to get in the first place? What advice might you offer to someone to position these to outside investors?
It's in one way, at least you've sort of highlighted that when you're doing your offering materials, noting at the top that the stock that you're offering for sale is QSBS, or that the investment is going to be made into a qualified opportunity fund, allowing all or a portion of the investor's capital gains to be rolled in, I think goes a very long way to demonstrating that you have looked at opportunities for mitigating losses and creating real opportunities on the gain side for your investors that that even if the business doesn't end up hitting a home run, that you can end up with home run-like results through combining the actual economic returns with these tax benefits. In other words, if the overall IRR in the business turns out to be 20%, but it's completely tax-free, that's like a 40% IRR.
Sure, yeah.
So if you're even if you're hoping to do extremely well, what this does is it enables your investors to do extremely well, even when you haven't knocked the ball out of the park, as they say.
Yeah, sort of on a like implied return basis with this. Yeah.
Absolutely.
Yeah, of course. Mark, thanks so much for running through those. That's the first time I think that we've gotten a really broad look at these types of incentives for capital going into new businesses and ways that you can efficiently take advantage of the tax code when you have losses in a business or other kinds of income in a business. And so, thanks so much for sharing. Hope to be able to stay in touch and maybe have you on again in the future.
Brady, it was an absolute honor to be invited. And so thank you so much for the opportunity to present to your audience. I hope that people found this informative, and you can always look me up on LinkedIn or the internet if you have any additional questions that you'd like answered.
Yeah, and we'll have links to Mark's page at Pillsbury, as well as ways that you can get in touch with other members of his team as well. They do great work. And yeah, thanks a lot, Mark. Appreciate it.
Thank you, Brady.
Thanks for listening to this episode of QSBS Solved. We hope to hear from you soon. Remember that the content shared on QSBS Solved is for informational purposes only and should not be construed as legal, tax, or investment advice. While we discuss strategies related to qualified small business stock, or QSBS, including rollover planning, listeners should consult their own tax, legal, and financial advisors before making any decisions. Laws and interpretations can change. Individual circumstances do vary.